Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and in today's episode, we have when a sizzling single asset syndication turns into a shitstorm, 50% loss. Thanks for checking out the show. As always, we really appreciate it. A couple of quick announcements, as I don't know that we've done a general episode here in a few weeks. I've really been trying to focus a lot more on our premium content and premium subscribers. This episode, I'm going to open it up and publish as a general episode. I was going to do this one as premium, but kind of want to give just the overall audience and listeners a taste into some of the things that we talk about and the level of detail that sometimes we get into with some of these things, and encourage you to consider becoming premium. You can use the link in your show notes to check it out if you'd like to do that. Speaking of premium, congratulations to Brandon A., who was the Q2 winner of a $25 Amazon e-gift card. As those premium subscribers know, Brandon has won more than once now, so we gotta get somebody else's name to hit the wheel next time, and hopefully they can win. But I'm sure he'll enjoy that. So again, congratulations to Brandon A. for being the winner of our premium subscribers for a $25 Amazon e-gift card. I took a look at the numbers for the show before we get into today's episode, and we are now in 80 countries. I was too lazy to go through and figure out what the new ones were, but I did take a look at the top three. As everybody knows, I think at this point, we are a US-based show, so coming in order from 1 to 3 in terms of listenership and downloads, we have number 1, the USA, number 2, Australia, third place is Zambia, and then there are 4 countries that are pretty much neck and neck, and those are in order: France, Canada, the United Kingdom, and Germany. So those 4 are neck and neck, but our top 3 respectively are USA, Australia, and Zambia. So thanks to everybody for listening to the show. As always, we appreciate it. So what I'm going to do today is give you a little peek behind the curtain, and I'm going to talk in more detail than I normally would, especially on a general episode, about a syndication that I personally invested in. And luckily, this was early on in my investment career in terms of real estate syndications, so I didn't have really that much money invested in it. But I got an email yesterday that kind of prompted me to record today's podcast. There's a lot of different things going on with syndications, good and bad, and I've made some more recent investments, and again, we'll save all that for another day. But what I do want to go through, and I thought this was an interesting exercise, is give you some information in pretty much excruciating detail. I'm going to limit and censor the names of the actual organizations, but I am going to give you, in some cases verbatim, some of the information that we received along the way as investors, and kind of really bring this to life in terms of what were we offered initially, what were they projecting, why, what was the sizzle, and what was going well. And then over the course of time, how that transitioned into a fucking shitstorm, which is where we are right now. And we are expecting a 50% loss on investor capital at this point. So I'm going to kind of take you from start to finish on that. Hopefully this, again, is insightful to you guys. I don't put this out there to, I don't expect anybody to feel bad for me. Like, I don't want to say I really don't give a shit. Like, nobody likes to lose money, but it really wasn't that much money to begin with. But regardless of the amount, it's more about the concept and the principles of this. And really, I looked at this as an exercise and an opportunity for me to take a step back and say, okay, what went wrong here? And was there something that I should have, as an investor, caught on the front end? Is there something that should have tipped me off to say, you know what, maybe I shouldn't go ahead and make that investment? And what would that have been, right? And kind of walk through that with you guys a little bit. At the end of today's episode, I'll get into a few lessons learned and, just some feedback in general and some things that I would do differently or not going forward. So sit back, relax, grab a drink, grab a popcorn, grab a workout if you're at the gym, wherever you listen to us. Again, we appreciate your listenership. Grab a premium membership while you're at it. It's only $5 a month.
Premium!
But here we go. So let's get into it. So back in September of 2020, so not quite, but what's that now? 1, 2, 3, 4, 5, almost 5 years ago, 4 years and some change, I made an investment into this particular single asset syndication. And the way that this works is I invested with a group who pretty much raises money and partners up with the actual sponsor running the deal. And if you're not really sure about, what a capital aggregator or capital raiser is versus an actual sponsor or operator of the deal, you may want to go back and listen to some other episodes. I've done a couple of them with ODOG on syndications. We did a real estate investment mini-series at one point. We have some premium episodes that are more recent where we talk about different types of syndication investment. Sometimes we get into some of those details. But basically, for the purposes of today, think of the group that I'm going to refer to as the donkeys, okay, as sort of the middlemen or middle people, if you will, right? So they're bringing these opportunities to investors. They're raising capital from these investors like myself, and then they are partnering up with the actual sponsor and operator of the deal, the people that are doing the work and actually managing the property and those teams and whatnot. So pretty much go through the donkeys to get to the other group, which I'm going to refer to as fuckface. This is an explicit podcast. This is not family friendly. I do this for entertainment and educational purposes only. Obviously, we don't give any advice on the show, but if you got kids in the car or you like stuff rated G, unfortunately, we're not the show for you. But if you like to let your hair down and cut up a little bit and have a little bit of fun, then listen on. So I got involved in September of 2020. And to start with, and this is going to be kind of long, and this would be a lot easier probably to present in sort of a webinar type of format, but being that we're obviously an audio-only podcast show, we're just going to kind of go through this. But I'm going to read to you basically 3 paragraphs followed by a few bullet points in terms of what the pitch was for this particular investment before we get into really the meat and potatoes and sort of some of the updates and what went well until it didn't. And then I try to play forensic accountant, essentially, and put the pieces back together in terms of like, how the fuck did this thing go wrong? This should have been a home run, but it wasn't. And why? Why not? So here we go. So this is the pitch. We are excited to present the opportunity to partner with us in the acquisition of the Shitstorm. And again, I'm taking the names of the actual groups and the property names out, but I'm going to try to read the rest of it pretty much verbatim. Okay, we are excited about the opportunity to present the opportunity to partner with us in the acquisition of the Shitstorm, a 300-unit value-add apartment community located in Jacksonville, Florida. Shout out to all our Florida listeners. The property was built in 2004 and is located in Florida's #1 rent growth submarket. The recent exterior improvements made to the property allow for a focus to be made on the interior value-add opportunities to accompany the already highly desirable unit mix that is offered by the property. The property is poised to capture $200 monthly rent premiums per unit as we invest about $9,000 per unit in renovations over a 4-year time frame. The current occupancy is 98%, and collections have been virtually unaffected by the pandemic, with collections nearly 100% of pre-COVID levels. The primary goal will be to return capital to investors within 5 years through a HUD refinance, in which case investors will receive a return of the majority, if not all, of their initial investment and still keep ownership in the project and collect dividends until the property is eventually sold. Investors will receive a 7% preferred return and 70% of the operating cash flow and profit from the sale. We are projecting strong cash-on-cash returns of 8 to 10% per year prior to the refinance. Please reference the financials document for more financial analysis, including example investment scenarios. So those are the first 3 paragraphs. Now I'm going to stop there for a second and comment a little bit on this. So one of the major appeals to a lot of investors, myself included, And in fact, I just recently, I don't think I've done a show on this yet, but I probably will here soon, made another investment with a completely different group and a completely different setup and structure. But one of the common things is that the goal is typically to get investor capital back to investors as soon as reasonably possible. And in the investor's mind typically, and in the sponsor's mind, the idea is to de-risk the deal by getting you your capital back. So you put some money in, ultimately you want it to come back with friends and get paid along the way, but you also want to get your principal back so that you can redeploy that elsewhere and continue, the investing cycle in terms of velocity of money, right? That's the goal. So a lot of these deals will have that as part of their plan, is to do a cash out refinance after the value's been added and the NOI, the net operating income has increased, and therefore the value of the property has increased, and they can basically extract and pull out the initial investor or a good chunk of the initial investor capital, give it back to the investors, and in the good syndications, quote unquote, you will continue to retain your proportional ownership and cash flow on the deal, assuming it cash flows. In the shittier ones, which I've been in before, and luckily those are behind me now, you actually end up getting diluted because they essentially cash you out. Again, a concept for another day. But that's the significance of their little comment here where they talk about returning a majority, if not all of the initial investment and still keeping ownership in the project. And that's very, very important because this particular group, there was a time where they did have deals where that wasn't the case. And I think investors like myself, when people kind of smarten up and you live and you learn and you know better and you ask the right questions and you provide your feedback, that they realize they can't continue to get away with that, right? So they changed it for this deal and for some of their other subsequent deals. So that was the introduction, that was the pitch. Further along, they have some bullet points of why we love this investment. And there's several, I'll read them to you here. Occupancy currently at 98% and collections nearly 100% of pre-COVID levels. That's number one. Number two, Jacksonville has experienced record-breaking population and white-collar job growth in recent years at double the national average. Number three, strong value-add opportunity as we increase rents by $200 per month per unit through unit improvements. Number four, built in 2004, the property is located in a well-established and affluent area. Number five, excellent, and we'll come back to this, excellent financing terms help mitigate risk of a potential downturn. Little hyphen, and they put in 10-year term, 2.75 plus DSCR, which is debt service coverage ratio. We'll come back to that. 66% loan to cost. Pretty much it was a fucking awesome loan until they fucked it up and got rid of it, which we'll come back to. 7% preferred return and cash flow from day one. Next bullet point, 8% plus average annual cash on cash returns. Next bullet point, 17 plus percent annualized total return. $20,000 minimum investment, open to accredited and non-accredited investors. So at the time that I made this investment, I'm pretty sure I was not yet, I might have been actually, let me think, 2020? Yeah, I was accredited technically. But when I first started putting money with these guys, the donkeys, I was not accredited. And that was one of the appeals to me. I think I mentioned this on another show. You could get in at a very low minimum, in this case $20,000, and that's actually what I invested was $20,000. So like I said, I don't expect any sympathy. I'm not really losing much sleep, if any, over this thing, but it is a good learning experience. But I made a $20,000 investment, and at the time, even if I wasn't yet accredited, you could pretty much be any Joe Schmo that wanted to come into a deal like this, and you could. For most of the deals in funds and whatnot that I'm in now, you do need to be accredited, and if you're not sure, I'm not going to spend a bunch of time on that, but there are typically income and net worth requirements in order for you to be considered accredited. There's a few other ways to be considered accredited, which again, we don't have time to get into today. But the point is, the check size was small, and pretty much anybody that could meet that minimum or was willing to meet that minimum could get in, right? And then the last thing here on the little pitch page was, this will be Donkey's second partnership with the Fuckface Group, a seasoned sponsor who has purchased and sold over 12,000 units across the Southeast United States with a strong track record of delivering in excess of 18% average IRR, internal rate of return, to investors on properties sold. Our first investment together is outperforming expectations. So that's their pitch. You're going to have a 300-unit apartment building in Jacksonville, Florida. They tell you all about the market. They tell you about the improvements that they're planning on doing, the time frame they're planning on doing those improvements, the fact that they're planning on getting your capital back to you, so on and so forth. And if you dig through, which I'm not going to get into super detailed, but they did have some additional documents, and as you're going through that, they performed a break-even analysis and a sensitivity analysis and things like that that pretty much say like, hey, how low could occupancy go while this thing, while we're still at least break even or making money before we go cash flow negative? Or, what happens, as they referenced in the pitch, under these different scenarios, if you make an investment of X dollars, what happens over time? What if we are in and out of this deal in 4 years versus 6 years, so on and so forth? So the term of this investment, the anticipated term of this investment was 3 to 7 years. A lot of these syndications at that time, and in some cases still today, are right around 5 years. Some are longer. And there's pros and cons to that. We don't have time for that right now. But they had a bunch of different metrics on there. But the time horizon for this was 3 to 7 years in terms of the investment. So that was the pitch, right? Get you your money back. You're going to have a preferred return accruing in the background. You're going to get cash flow along the way, right away. Like, this is looking good. We are raising money and basically, giving it to this experienced sponsor who's executed before. Their numbers look good. Like, everything seemed like it was just a sizzling deal. And I wouldn't say that it's too good to be true or that the pro forma or projections were too good to be true by any means. I think that they were reasonable given the facts and circumstances in the market environment at that time. But that's what the pitch was. Okay? Now, obviously, you want to do your own due diligence, and you can dig deeper or not and whatnot. But that was the pitch. So we make the investment, right? We're in. September 2020. Here's a check, $20K to your face. Let's go. All right? So what happened from there? What turned this from a sizzling single asset syndication to a shitstorm? And before I go further, I think it's very, very key. And one of the takeaways, I don't know if I put this in at the end or not, but I'll mention it now before I forget, is that I am much more likely to and have commit to fund structures where there's multiple assets in the fund or that will be purchased in the fund as opposed to a single asset syndication. So an example would be you decide to invest in a multifamily fund that buys apartment buildings with certain criteria. And their goal might be to have X number of apartment buildings in the fund, a bunch of different apartment complexes in the one fund. Versus saying, hey, we have this one single specific 300-unit complex in Jacksonville, which is what this was. I think from a risk standpoint, generally speaking, the fund structure, although you have to be careful on how those funds are structured. And again, we're not going to get into a ton of that now. I think I did a premium episode on some takeaways and feedback from a real estate conference I went to not too long ago where we spent a lot of time talking about these types of investments. So if you're interested, become premium, go back in the archives, check that out. But I think from a risk standpoint, using a fund structure and investing through a fund structure can oftentimes mitigate your risk. Now, with that said, there's also a lot more sort of reversion to the mean, if you will, in terms of your return. So you could have one deal in a fund, for example, that knocks it out of the park. And then the next deal in that same fund that sucks wind. And a bunch of deals in that fund that do okay. And you're going to have mediocre, okay returns, right? Hopefully they're still going to be better than, you might be able to get in the public markets. And that's, again, debatable. But that might be one way to look at it. Whereas with the single asset syndication like this, if things continued to go well or their pro forma projections were met, this could have done phenomenally well. But if things turn for whatever reason or things don't go as planned, which was the case here ultimately, then things can really shit the bed and you can end up with a 50% loss like I'm basically going to, right? So those are some things to think about and some things to consider as an investor when you're looking at risk. And that's one of the lessons that I learned from this. I am not to say I'll never do a single asset syndication again, but I am less likely, given the opportunity and the option, to invest in a single asset syndication versus a fund structure. So just a quick little side note there. All right, so let's get into this. So we invest, we write the check, like I said, and we get periodic updates. So first update, we invested in September of 2020. Usually it's at least a quarter or so, in arrears that before you start getting distributions, assuming there is current cash flow. And in this case, there was expected to be some current cash flow. And so, we get the update, boom, they closed the thing in October, high fives all around, bullshit, blah, blah, blah. And starting in January of 2021, we got our first quarterly distribution. April, another quarterly distribution. July, another quarterly distribution. October, another quarterly distribution. And this thing starts spitting off a little bit less than initially, I think, anticipated, at least in the beginning. But, it was north of, we'll say, mid to upper 5% distribution rate. And then it got up to high 6s, almost a 7% annualized distribution rate. So it was spitting off, a little bit of cash there for that time period. Well, we get an update in June of 2021 that says the following: the multifamily market in Florida remains strong. Based on recent sales comps and our new operating numbers, we believe the property is worth $10 million more than we paid for it around 8 months ago. So that could be good or bad. And as we'll find out later on, spoiler alert, this market, was very competitive, and there was quite some competition that came in place and pretty much crushed our hopes and dreams in some cases. That's not the only reason, but that definitely was a somewhat of a contributing factor. But, whatever. So anyway, things appear to be going okay. Everybody's still excited. Distributions are still happening. That was around June of 2021. Then we get into March of 2022. Before I read that one, let's see here. So January of 22, distribution. April of 22, right around that same time of the March, distribution. Distributions continued throughout all of 2022, and things were going fine. We get an update, March of 2022. We are pleased to inform you that we closed, and I didn't understand the significance of this at the time, which we're going to spend a decent amount of time on this. We are pleased to inform you that we closed on a quote-unquote bridge to HUD loan with lender. I'm not going to say their name. There's a lender that they went through for that. Although much of the proceeds are being held in escrow pending our formal application to HUD, we are able to distribute about 30% of the principal that you invested about 18 months ago. Once we make our formal application to HUD, which should be in approximately 60 days, we will be able to make another distribution of a similar amount. The exact amount will be based on the highest achieved leases at the time of submission and prevailing interest rates. Once the application to HUD is submitted, we expect to be on track for a cash-out refinance in Q4 2022, which should return all or most of any remaining invested capital. Okay, let's take a pause there. So what the fuck is going on? Well, what they were doing, as we talked about in their pitch, basically, they want to try to return investor capital. Perfect, okay? And I think they were a little bit, this is me reading in between the lines after the fact, because I didn't realize this at the time. And even if I did, quite frankly, once you write that check or wire the money, you have no control. That's one of the downsides of these private investments. Not only are they illiquid in most cases, but your level of control is basically zero in most situations. There's going to be a couple exceptions to that, but that was the case here. So they were trying to get investor capital back to us as quickly as reasonably possible, but there were certain requirements that needed to be met, which we'll get into here in a little bit, before they could get that long-term HUD loan. Now, by the way, like I mentioned on essentially the pitch sheet, right, and those bullet points, they already had a very sweet loan on a 10-year fixed term, conservatively leveraged, very low interest rate, interest-only payments the first 3 years. Like, they could have sat on that loan for a lot longer, but they were trying to get us our capital back and continue on with the business plan, all right? And in my opinion, they got a little bit overly excited. So instead of waiting and just doing the HUD loan, they said, fuck it, we're going to get a bridge loan. So that's why they call it a quote-unquote bridge to HUD loan with the lender. And basically what I think happened is they went ahead and got that bridge loan, which typically is going to force you out of your existing loan. So the sweet-ass loan that was on the pitch page that I was pretty excited about and thought, okay, and they even put a little statement in there on their bullet point. Excellent financing terms help mitigate risk of a potential downturn. Well, yeah, asshole, it does if you keep the fucking loan. But if you don't, then maybe it doesn't mitigate risk, right? Hindsight's 20/20. So they go ahead and they get this bridge loan. In the process, they return about 30% of investor capital back, right? So at that time, like I said, I put in about 20. I think I got back right under 6. So they had, essentially done a return of capital back to the investors, which is not a bad thing. The problem with that is bridge loans typically have variable interest rates, okay? So, but they're thinking, whatever, we're doing this in Q1 or at the end of Q1 going into Q2 of 2022, and we're going to have the permanent cash out refi done through the HUD loan in Q4 of 2022. So what's 6 months? Who gives a shit? It's a variable rate, no big deal, right? Then this is where I think things started to turn, and this is a seemingly small decision that ended up having an outsized impact on everybody and ultimately, in my opinion, led to the downfall of the limited partner investors like myself. So they do this. They return that 30% of the principal to us. We get some of our money back along with our normal distribution, right? Life's good. Everything's fine. You have less money left in the deal now, and things continue, okay? And then again, as we go through, like I said earlier, all of 2022, distributions should continue. January of 2023, we got a quarterly distribution. Then things stopped. So we got an update. This is September of 2022. They said, the sponsor is still waiting on the occupancy. They said a lot of things. I kind of clipped out what I thought was relevant for today's podcast. So I'm not reading you like entire updates. We get a lot more information in this. This is just what I think is relevant to the ultimate trajectory of how everything unfolded. And I guess technically it's still unfolding because we haven't gotten our funds back yet, but the sale of the property has been completed. So the sponsor is still waiting on the occupancy of the property to reach 88% or more, which is a requirement of the refinancing lender as the current occupancy is in the low 80% range. Well, that's interesting. Remember before it was 98% and supposedly COVID, it was virtually unaffected, blah, 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 blah. Okay, well now we're in the low 80s. That's not good. The current occupancy rate is largely due to our partners forcing vacancies during Q3 to move forward with the final unit renovations across the property. So pretty much they want to fucking flip this thing. So they're pretty much telling people when their lease is up, hey, we got other units that are fully, renovated. Yeah, they might rent for a little bit more. You can go over there or you can get the fuck out. Right? They didn't exactly say it like that, but that's pretty much what's going on here. As of a few weeks ago, all 300 units of the property had been renovated and are awaiting leases to achieve occupancy levels of 88% or more. Our partners are hopeful to get the refinance finalized by the end of the year, like they said in the last update. But these are slower leasing months, so there is a chance the 88% occupancy level is not met by year's end, right? And this should have been like an oh shit moment right then and there, but you kind of just assume, well, whatever, they know what they're doing. They're in the low 80s. They got to get to the high 80s. We're coming into the fall and the winter months. Yeah, it might be slower. So maybe it gets kicked to, spring of 2023, right? We were still getting distributions at the time as of, September of 2022, whatever. So we get another update. Again, we got a quarterly distribution in January of 2023, and then distribution stopped. We get an update in April of 2023, and this is where things, I think, really went south here. So it says the team was able to purchase a 1-year renewal on its interest rate cap, giving them the time needed to allow the asset to fully blossom, after completion of the rigorous 3-year renovation project. So they buy a 1-year interest rate cap. So right there, that tells you that this bridge to HUD loan, this bridge loan, was a variable rate loan, and they had to extend the rate cap, right? And they had to buy the rate cap, obviously, and purchase that in order to do that. And we're still playing the waiting game at this point. So then we get, again, distributions at this point are stopped, and quite frankly, they never picked up again. We get an update in October of 2023. As previously reported, distributions will be suspended until the refinance of the property is completed. Due to the increasingly difficult debt markets, our partners are still exploring alternative options that will result in the best outcome for the property and help secure its long-term success. They gave it the old college try, right? Fast forward to December of 2023. Refinancing plans. There's a few bullets here. The property was marketed for sale at the end of 2022 and in the first quarter of 2023. Due to the uncertainty about the economy and the direction of the interest rate environment, the buyer pool was extremely weak and offers came in more than $10 million below the value that was estimated. As a result, the property was taken off the market. Okay, that seems fine. The current intention is to refinance the property with fixed rate intermediate debt between now and the upcoming May 2024 expiration of the current interest rate cap. Extending the in-place financing and renewing the interest rate cap for another year is also possible. So, translation, we are starting to get into oh shit mode because they had the great financing that they did. They took it out with the bridge loan. Then they had to buy the rate cap. Now they try to bring it to market to sell. They can't fucking sell it. Occupancy is not enough to get the permanent financing through HUD. Like, shit's just starting to really go downhill at this point. As of current loan pricing and sizing, there will be an underlying fixed rate refinance loan at a rate in the high fives. Currently, the refinance plans include taking on, and this is another key point, include taking on some preferred equity to accomplish a quote-unquote cash neutral refinance. However, if rates continue to come down and occupancy and collections continue to improve, the Freddie Mac refinance proceeds could increase enough to where preferred equity is not required. Being an investor now that is more informed than I was when I first started this investment several years ago, and having money in different syndications, including a fund that went on a time period where they're using a lot of, and to some degree still are, and actually they opened up another one recently that I invested in, where they are using quite a bit of preferred equity. Going back to something I'll mention at the end, but I don't know if I mentioned it yet on today's podcast, but if you look at the capital stack, right, if shit goes south, who gets paid first, who gets paid last, who gets fucked first, who is probably going to be okay and be safe. And if you look at the type of investment that this was a common equity investment, right? You are at basically the top of the capital stack. Your capital, your investment is the first to go and get wiped out if things don't go right. But at the same time, you typically have the highest potential returns by being in that position in the capital stack. The inverse of that is at the bottom of the capital stack. That's typically going to be the lender that's in first position or primary position that lends on the property itself, right? First lien position. The returns to them and anyone that invests in debt or credit are probably not going to be quite as high, but your position in the capital stack is way more secure, and you're more than likely going to, your money's the last one to get lost, basically. Everybody else gets chipped off starting from top to bottom before you do, if you're at the bottom of the capital stack there. And then, of course, you have preferred equity that's going to sit in between the two. So all the common equity folks, including myself and other limited partner investors in this particular deal, would get wiped out before the preferred equity folks would have their capital wiped out. So as much as it sucks to say that I wasn't in that position in this deal, and quite frankly, that was not offered in this deal when I entered it, and that's okay, I am in that position in some of my other investments. And one of the things that they try to do when people invest in preferred equity is they will try to negotiate terms in such a way that they have what they call control rights. If they write a big enough check, they have control rights and can force things to happen, including the sale of a property, which we'll get into here is exactly what happened to us. And we can't really do anything about it because they're trying to protect their capital. So even if we take a total loss, partial loss, haircut of any kind, they don't really give a shit because they're in the middle of the capital stack and they're going to watch you lose your money first before they lose theirs. And they have the ability to control the authority to force a sale if those control rights and provisions are granted to the folks that are getting in at the preferred equity level. You might think that the takeaway is always invest in preferred equity. I don't necessarily think that that's true either, but that's a conversation for another day. So when they're talking about this in their December 2023 update and taking on preferred equity, that's what they're referring to. Although they say at the end that it may not be required. Well, fast forward, September of 2024, and there were some updates in between that I kind of skipped over, but everything was kind of status quo. September 2024, the sponsor brought in a preferred equity partner to help pay for the rate cap on the loan extension completed earlier this year. The preferred equity partner would like the property to be taken to market for sale as soon as possible. Still, the sponsor's goal is to continue increasing operations during the remaining loan life and then evaluate a refinance or sale once the terms expire. So again, the preferred equity people are like, no, sell the fucking thing. The sponsor's like, well, we're still going to try to do the best we can. And the investors at the top of the capital stack like us, the common equity folks, are like, well, we're just along for the ride. We were swinging for the fences on this one, but we might, end up getting kicked in the nuts with no cup. And here we are. So fast forward to December of 2024, and they say, as previously reported, the sponsor brought in a preferred equity partner to help pay for the rate cap on the loan extension completed in 2024. The sponsor's goal was to continue increasing operations during the remaining loan life and evaluate a refinance or sale once the terms expire. However, okay, and this becomes their problem, also becomes our problem now, the preferred equity partner has run into issues with several of their own projects, their other projects, and would like the shithole, or what did I call it before, the Shitstorm apartment complex, to be taken to market for sale as soon as possible. More information will be provided as details evolve. So now you basically have conflicting interests, right? You have preferred equity people that are like, we're fucked with our other shit right now. We want our money back. Go ahead and sell the damn thing. We don't give a shit what happens to your investors and what you're trying to do with your project. We were just here to get an advantageous position in the capital stack, help you guys buy the rate cap, but at the end of the day, we're going to cut your fucking legs off, right? And that's basically what was going on there. So, that was the update there, December of 2024, and those are all the ones that I had copy and pasted in there. So now I get the email yesterday, and then there's a letter attached to this, but I'm going to read this letter to you guys, or read the email. So, sale completed, the shithole apartment homes. Dear investors, we would like to inform you that the shithole apartment homes has been sold. The transaction was finalized last week. A detailed update received from our partners, Fuckface Group, has been attached to this update. The details below summarize the information within the attached documents. And then they go through several sections here. So, initial performance. So from 2020 to 2022, the property paid consistent quarterly distributions through Q4 2022. We talked about that. There was a partial return of capital achieved via a HUD refinance in early 2022. Well, it really wasn't a HUD refinance. It was a bridge to HUD refinance. It was a bridge loan where they got us some of our money back, but whatever. Emerging challenges between 2022 and 2024. Operating costs increased due to higher insurance and property taxes. Faced significant supply pressure from new competing units in the market. Sponsor focused on operational improvements to prepare for a recapitalization. That was all between 2022 and 2024. Then, May of 2024, loan extension and rate cap. A rate cap purchase was required to extend the bridge loan. Sponsor avoided a capital call by securing a short-term loan from a preferred equity lender, which is where we got fucked. Property had 4 years of operational stability despite rising expenses. Well, who gives a shit if we end up having to get in this situation, right? Mid to late 2024, occupancy and revenue decline. After a strong revenue month in May, collections dropped by $50,000 a month. Occupancy fell to the low 80% range due to aggressive concessions by nearby properties. Preferred equity lender pressured a sale amid market challenges. So they start talking about basically shit going south mid to late 2024. And then sale process and due diligence issues. In December of 2024, asset was under contract for $53 million, expected to return 75 or about 75% of the capital. The buyer, so this is another investment group at this point that's coming in to buy this apartment complex. The buyer alleged between $3 and $9 million in water damage repairs based on a 200-page inspection report. The sponsor and contractors disputed the claims, citing no prior evidence of issues. The buyer renegotiated to a $49 million purchase price. At that point, sponsor remarketed the deal. A new offer of $52.2 million fell through after the buyer learned of the previous inspection report. Sponsor ultimately sold to the original buyer at the reduced price. Final outcome. Investors are expected to recover about 50% of their capital, resulting in a 50% loss. So, final outcome. Donkeys is the single largest investor in this project, and this investment marks one of the largest across our portfolio. So this is the group that I directly invested with at this point. They're the ones, basically the capital raisers, saying that they have the single largest position or single largest investment in this particular project. This represents a rare instance in our company history where we have lost principal, and it's a terrible result. We are committed to navigating this market cycle as thoughtfully and strategically as possible, with the goal of positioning ourselves and our investors for long-term success. And this is bullshit. We genuinely view all of our investors as friends and family. No, you don't. And we will continue doing everything we can to create strong outcomes over time. We will provide the exact numbers from the sale and final commentary when we get additional information from the sponsor, the Fuckface Group. We thank you for your patience during this process and look forward to providing additional information as soon as we receive it. Sincerely, the Donkey Team. So that's what they sent us. They also attached a letter that the Fuckface Group and the leader of the pack there sent to their investors. So if you picture this, the Fuckface Group are the ones that are essentially operating this deal. They have their own investors, but then there's other groups like the Donkeys, which is the group I invested with, that they bring in to help them raise money to fund these deals, and they partner up with. So this is a letter that the Fuckface Group sent to their own investors that invested directly with them at the Fuckface Group. Dear investor, we are writing to inform you that the Shitstorm has been sold. The transaction closed on, fill in the blank with the date. The property's bridge loan, preferred equity, and rate cap all matured on May 1st, 2025. In the current market environment, we were unable to identify a viable path forward and ultimately concluded that committing additional capital to retain the asset was not a prudent course of action. On May 1st, we were required to purchase a 1-year interest rate cap to exercise our loan extension rights. To avoid a capital call, we borrowed the required funds from our preferred equity lender. At that time, the Shitstorm had demonstrated 4 years of stable operating performance despite significant increases in insurance and tax expenses. We believed there was a strong possibility interest rates would normalize over the following year, allowing us to refinance or sell at a more favorable valuation. Attached is a report from blah, 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 detailing the significant decline in price per unit across Jacksonville submarkets between 2022 and Q1 2025, a trend driven largely by the sustained rise in interest rates. After a record collection month in May 2024, monthly revenue declined sharply. From July through December, collections averaged $50,000 below the prior 4-year average, primarily due to several new competing properties offering aggressive lease-up concessions. So you know those signs that basically say like, hey, 1 month free rent, or 3 months free rent. That's what they're talking about. This placed pressure on occupancy, which fell to the low 80% range before recovering. During this period, our preferred equity lender, who had recently provided the funds for the rate cap, insisted that the property be brought to market. Concerned about their urgency to exit, quote-unquote, at any price, we focused on preserving as much investor equity as possible. Despite a professional marketing effort, buyer interest was limited due to both market conditions and the asset's underperformance in the second half of 2024. In December, we reached an agreement to sell the property for $53 million, which would have returned approximately 75% of investors' initial capital, including prior distributions. During due diligence, however, the buyer requested permission to perform invasive testing related to the suspected water intrusion behind the exterior stucco. We denied that request, but permitted non-invasive infrared testing given the approaching loan maturity. It's important to note that infrared scans detect only temperature differentials, not moisture, and are not considered reliable tools by lenders or federal agencies for identifying water intrusion. Following the testing, the buyer presented a 200-page report alleging systemic water issues and estimating between $3 and $9 million in necessary repairs. Our contractor, who was on site during the inspection, along with our team and broker partners, strongly disagreed with the report's findings. Over 5 years of ownership and regularly quarterly unit inspections, we have found no signs of water intrusion. In February, the buyer attempted to renegotiate the price to $49 million. Despite pressure from the maturing loan, we remarketed the property in February and March through, and they mentioned the brokerage. During this time, collections had rebounded and we secured a new offer of $52.2 million from a qualified buyer. Unfortunately, when that buyer became aware of the prior report, they withdrew. With no viable alternatives remaining, we proceeded with the original buyer at the reduced price. Net proceeds from the sale were sufficient to fully satisfy all outstanding debt obligations, including the preferred equity. Remember, those bottom two positions of the capital stack are getting paid first. However, after closing costs and the purchase price reduction, investor returns, now talking about us, the limited partner investors in the common equity position, investor returns fell significantly short of the original investment. Including prior distributions, approximately 44%, we expect total returns to represent approximately 50% of initial capital, resulting in a net loss of roughly 50%. We understand how disappointing this outcome is. I am personally the largest investor in this project with an investment in excess of $2.5 million. So this is the head honcho guy with the fuckface group that's talking about this as an individual investor, not as a collective group like what I was talking about earlier with our group. While this represents a significant personal loss, my greatest disappointment lies in the loss experienced by you, our investors. Though the asset performed consistently for much of the hold period, persistent interest rate increases and a muted transaction environment ultimately constrained our options. We sincerely thank you for your trust, patience, and partnership throughout this investment. If you have any questions or would like to discuss further, please do not hesitate to contact me. Sincerely, Senior Fuckface. So, it is what it is, right? Everything was going well until it wasn't. I think there were a couple of key points, like I mentioned earlier, in this whole thing. I think if I had to go back and do it again, I don't know that I would say I wouldn't have invested. But what I would want to do if I were to consider this investment at this stage, knowing what I know now, is I would want more information in detail from the fuckface group in terms of their documents and what they are allowing or not allowing and what can and can't be done in terms of restrictions on taking on leverage or using alternative financing methods. Pretty much, worst case scenario, like what can go wrong? What can you guys do? Where can you go for capital if you need capital? And would that have necessarily changed my decision? I don't know, but at least I would have been more aware of what they were able to do. So that was one of my lessons learned. First lesson, know your position in the capital stack. Like I mentioned earlier, right? You have different positions, and if you're common equity, which is what a lot of these deals are, you're at the top of the capital stack in the most vulnerable position, and yes, you have the potential to earn the highest returns, but you also are the first to get wiped out. So you really need to think about, is that where you want to be in the capital stack? And for some people, the answer is yes. In fact, I just put money into a deal where I'm going to be in that position. And for other people, the answer is no. I put money or committed money, they haven't called it yet, in another fund, in another deal where I'm not going to be in that position. We are mostly going to be doing preferred equity in that case. So you want to diversify your position to the extent that you can in the capital stack. And again, when I talk about that in some of the premium episodes, we're not going to spend too much time on that today. But knowing your position in the capital stack is important. Understanding the restrictions or not that the sponsor might have, like I just said, is important. And then finally, my third lesson, and it probably sounds super cliche and should go without saying, but diversification is key. No matter how much capital I was looking to place or invest at the time, you never want to put all your eggs in one basket. In this case, again, I used to call them little nuggets, $20,000 nuggets, $50,000 nuggets, whatever. It's one that, I probably lost half of it, it sounds like. But you know what? Lesson learned, and I'm almost looking at that as tuition. Is that going to stop me from continuing to invest? No. In fact, my check sizes have gotten a little bit bigger, as I've talked about on some of the other premium shows, and will likely continue to get bigger, and you become better over time. With all that said, I don't think that there was any funny business going on. I think that everybody meant well. Everybody did the best they could. But I think that there were some clear instances where from the very first time, I think the sponsor got a little bit overly aggressive and optimistic, thinking, well, we'll do this bridge to HUD loan to get the investors some of their money back, and we'll get them the rest back in 6 months when we do the HUD refinance. I don't know if that was necessarily a prudent step or even a necessary step given the original financing that they had in place, which was very, very favorable. I think that they could have gone from that original financing to the permanent HUD financing. The only wrinkle in there is that, like I mentioned, the original financing they had, although it was very favorable, it was only the first 3 years that were interest only, and then it was going to be an amortizing loan where they were going to have to start paying principal and interest, and the payment would have gone up significantly, but it still would have been well within range from their sensitivity analysis. So I guess what I'm trying to say is I think if like they kept the original loan and only did a refi when they could get to the final permanent financing with HUD, would have been a better outcome. But instead, they decided to take the bridge loan. When they do the bridge loan, they take out their original financing that was, in my opinion, very favorable. And they even say very favorable and attractive. And that was the start of the shitstorm, because from that point, you've now taken out your original financing. You're no longer on a fixed rate like they were. You've gone to a variable rate. Then, and nobody really could have saw it coming, but interest rates spike very sharply. And all of a sudden now you're having to purchase rate caps. And you don't want to go back to your investors and do a capital call and say, hey, assholes, like we need more money because we did this, or that. Instead, they said, well, fuck it, we'll go to our preferred lender. We'll have them help us buy the rate cap. And they did. But they also put themselves in a more favorable position in the capital stack, and therefore were able to force a sale at a time that was beneficial for them, but not necessarily beneficial to us, the common equity investors. And so, again, that's a lesson learned that I will be looking for going forward is, especially if I'm going to be in a common equity position, is there ever going to be a situation where somebody else can insert themselves in the middle of the capital stack ahead of us, essentially? In other words, can our interests become subordinate to their interests? I don't mind long-term fixed rate favorable financing with a lender, just like you would get a mortgage typically on your primary residence. I don't care about that, but it's the next loan that comes in after that one before your common equity that could be the problem. And here, that's essentially what happened. So you live and you learn. I had a little bit of fun with this one. It's kind of a good exercise for me to be able to reflect on it and kind of see what I think went wrong and when it went wrong. And you know what? That's just the way that it goes. It sucks because if we were able to hold on a little bit longer and, they didn't get involved with the bridge loan and the variable rate debt and the interest rate cap and the preferred equity and all the shit that started to follow, we probably still would have maintained control of the property today and then had an opportunity to sell it at a more favorable valuation, like they said, down the line, when we could have hopefully made a nice return on our investment instead of getting, a pole shoved up our ass for 50%. So that's kind of where it is. I had some fun with this. Like I said, I'm not really mad about it. Nobody likes to lose money, but again, $10,000 or whatever, it's not going to change my life. $20,000 is not going to change my life. So, it sucks on the one hand, but on the other hand, it's a learning experience. And again, if I had to go back and do it all over again, I don't know that I would have done anything differently except ask additional questions and look for additional information. But assuming all that checked out, it's possible that I still would have made the investment. So that's where we are. Again, don't forget to diversify. Not a recommendation. This show is for entertainment and education purposes only. We appreciate you listening, and we will see you in the next episode.
Check the mic and make sure it sound right, boys.